After a disappointing 2021 Q4 earnings report, Disney stock saw an 11% decline. This is over 23% down from the 52-week high. With the Walt Disney Company being one of my largest investments, I've been asked to share my thoughts on the situation. So in this video, I'm going to dive into the latest quarter, earnings call, and share my thoughts on the company long term. My name is Zach, and you should leave a like and subscribe to the channel if you enjoy the video. In the most recent quarter, Disney missed Wall Street estimates on both earnings and revenue. On top of this, Disney Plus subscriber gains came in lower than Wall Street projected. They had 2.1 million subs, while Wall Street projected 9.4 million ads. However, this was closer to Disney's internal projection of, quote, low single-digit millions. Nonetheless, this weakened the company's story around streaming growth, which had been propping the stock up. We'll circle back to the streaming services later in the video. Disney's financials are still in a major recovery from the pandemic. All of Disney's global theme parks were open in the fiscal fourth quarter, and all of its cruise ships resumed sailing. Last quarter, the Parks Experiences and Products segment produced positive operating income for the first time since the pandemic began, and it improved on those results in Q4. However, this is still not anywhere near 2019 levels. If we dive deeper, we can see the domestic parks have positive operating income, while international parks are still at a loss. Their consumer products division is currently the real profit driver in this segment. Personally, I thought the parks division would recover much faster than it is. It seems I was too optimistic and it will be a slower recovery. I don't expect we'll get close to 2019 numbers until the end of fiscal year 2022. On the positive side of parks, Disney CEO Bob Chapek mentioned on the earnings call that the new Disney Genie service has been a financial success.
Introducing a new way to get more out of your Disneyland or Walt Disney World visit. Disney Genie service. It creates your best Disney day, inspired by the things you tell us you love. And offers complimentary new features to make planning easier. Want to make the absolute most of your time? Purchase Disney Genie Plus service with your ticket to use our new Lightning Lane entrance at a variety of attractions. You'll save time in line as you make one available selection at a time throughout the day. You can also purchase a time to arrive at one or two different individual attractions each day using the Lightning Lane entrance.
Disney Genie basically acts as your guide to help plan and schedule your Disney trip. Disney Genie Plus costs $15 per ticket per day and allows you to save waiting time by reserving their Lightning Lane entrance. On top of this, you can pay for Lightning Lane entrance separately on some of their highest demand attractions. This includes rides like Space Mountain and Star Wars Rise of the Resistance. Disney Genie is currently only available at Walt Disney World and will launch at Disneyland soon. Chapek said that 1/3 of all Disney World visitors now pay for Disney Genie Plus. He mentioned that when parks return to pre-pandemic levels, this service and other improvements will lead to far greater margins. With time, the parks will become cash cows again. However, there are still capacity restraints globally and increased pandemic-related costs. One recent positive catalyst is the increase in international travel for vaccinated individuals. International travel is a key component of returning to 2019 levels and beyond. Another recovering aspect of Disney's business is theatrical releases. It's made significant improvements from 1 year ago, but still not at pre-pandemic levels. Their largest releases were Marvel's Shang-Chi and Black Widow at $430 million and $379 million global box office, respectively. By no means terrible, but not at the billion-dollar level these movies have the potential to hit. I think over the next 1 to 2 years, we will see some Marvel movies eclipse this billion-dollar mark once again. With that said, consumer behavior has changed and the future of theatrical releases remains to be seen. Bob Chapek said that the company will remain flexible with premiere access on Disney Plus versus exclusive windows in theaters. This is the correct decision. They're still gathering data and will do what's best for shareholders in the long run. The company should not run away from the box office given how profitable it has been in the past. During this horrific time in Disney's history, you might think that the streaming service were the main thing keeping them afloat. You'd be wrong. It's actually their linear networks, traditional television. It's highly profitable and accounts for virtually all their current operating income. The problem is that business has a limited future and will likely slowly decline over time. Don't freak out though, because it's going to stick around for quite a while. Disney's direct-to-consumer streaming services are actually unprofitable. This is expected, though. We are currently in a long-term growth story for Disney. The streaming services will remain unprofitable until they reach scale and/or utilize pricing power to increase average monthly revenue per user. Currently, Disney has 179 million total subscriptions across its direct-to-consumer portfolio. That's right, I said portfolio. Disney owns 3 streaming services: Disney+, ESPN+, and Hulu. They also have a bundle where you can get all 3. Disney Plus has 118.1 million subscribers, which is up 60% from last year. The average monthly revenue per user is $4.12, which means the service generates an estimated $486 million a month and $5.8 billion annualized. ESPN Plus has 17.1 million subscribers, which is up 66% from last year. The average revenue per user is $4.74, which means it generates an estimated $81 million a month and $972 million annualized. Hulu SVOD has 39.7 million subscribers, which is a 22% increase from last year. The average revenue per user is $12.75, which generates an estimated $506 million a month and $6 billion annualized. Hulu with live TV has another 4 million subscribers, which is actually down 2% from last year. The average monthly revenue per user is $84.89, which is an estimated $339 million a month and $4 billion annualized. In total, the streaming services generate an estimated $16.92 billion in forward revenue. Over the last year, they increased their direct-to-consumer revenue by 55%. So am I worried about the slow Disney Plus subscriber growth in Q4? Not really. CEO Bob Chapek said that you should expect non-linear growth of the streaming services. By this, he means sub-growth will not be consistent every quarter and instead be highly variable depending on specific content released, promotions, and expansion into new regions. Any individual quarter will ultimately be a blip over time, and it's better to focus on the long-term trends. Chapek reiterated that they are still on pace for their Disney Plus subs target of 230 to 260 million by the end of fiscal year 2024. They plan to accomplish this by expanding to new markets and increasing content production. Some examples of this expansion include Japan, South Korea, Taiwan, Hong Kong, Greece, Israel, South Africa, the Philippines, and Vietnam. A major focus of theirs is growing subscribers in India through Disney Plus Hotstar. They expect 30 to 40% of Disney Plus subscribers will be Disney Plus Hotstar. This is a service specifically designed around original Indian content. Original content designed for specific regions is a huge part of their global expansion. By the fourth quarter of 2022, Disney expects to reach full content production with significant releases from all major studios: Disney, Pixar, Marvel, Star Wars, and National Geographic. The goal is to have something noteworthy coming out every quarter from each studio. This is just the beginning. So yes, in Q4, Disney Plus only added 2.1 million subscribers, and I just described why I don't think this is indicative of a long-term trend. But this is only one of their streaming services. ESPN Plus added 2.2 million, Hulu added 600,000, and Hulu with live TV added 300,000. So in total, they added 5.2 million subs, which is a more full picture view of their direct-to-consumer business. Also, it's important to remember where we came from. I'm going to play this interview of then CEO Bob Iger when Disney Plus was announced in April 2019. Listen to the first question.
Relatively ambitious goals in terms of subscriber projections, between 60 and 90 million on the Disney Plus service by fiscal year 2024 or the end of.
Correct.
Relatively ambitious goals. The initial target for Disney Plus by the end of fiscal year 2024 was 60 to 90 million subs. We now know that they reached this after their first year. Why?
We have almost 100 years of creating great content that the world loves. Under Disney and then Marvel and Pixar and, of course, Star Wars, and then adding National Geographic to it. And I think when you start with a brand base that is that strong, then you have an advantage basically in the marketplace because of the love that people have for that brand and the desire to be entertained by it, to spend money on those brands. We've seen that in multiple ways as a company.
The strong brands at Disney create a huge competitive advantage decades in the making. Also, an unforeseen pandemic helped boost initial subs. Despite that, I still think Disney would have reached 60 to 90 million subs well before 2024. The next question is very important in order to understand the monumental shift that streaming was to Disney's business.
The license fees that you're going to forego as a result of now putting so much of your own content on the platform are significant. Some say as much as $2.5 billion in incremental profits in 19, perhaps as much as $5 billion a year by the early 2020s that you're foregoing in license fees. Why is that is it the better way to go?
Because I think there are platform economics that trump license fees to third parties. We can start with the affinity that people have to the brand. They want to be connected to it. But obviously, the ability to have a direct relationship with the consumer gives us, I think, an opportunity to, in having that relationship with them, to monetize much more effectively. If you look at this company over the years where we've been distributing movies through movie theaters, and the movie theater is the relationship with the customer, even though it's our product that is touching the hearts and basically becoming part of the deep and happy memory. The cable channels or the satellite the channels are distributed through satellite providers and cable providers. The customer relationship is theirs. The consumer products are usually sold by big box retailers. The customer is theirs, or by Amazon. I could go on and on. We have a customer relationship with all these folks through third parties. And other than our theme parks, where we have a direct relationship, we don't know who these customers are. And in knowing who they are, I think we have an opportunity that is extraordinary. If suddenly your customer relationship is much tighter, if the proximity between you and a customer is better, then you're going to serve them a lot better across your platforms.
Disney is foregoing current profits from licensing its content to other platforms. Instead, they're betting on themselves and building their own platforms to cut out the middlemen. This is more elegant for the consumer and gives the company far more control over its destiny, not to mention the fact that subscription platforms can become highly profitable once they reach scale. All you have to do is look at Netflix, which has already crossed the threshold and is reliably growing significant earnings. They are in the early phases as well. Disney has huge potential to grow into a streaming juggernaut over the next decade. The company's current fiscal year 2024 subscriber estimates are as follows. Disney Plus is expected to have 230 to 260 million subs, reaching profitability in the fiscal year 2024. Hulu is projected to have 50 to 60 million subs, reaching profitability in the fiscal year 2023. ESPN Plus is expected to have 20 to 30 million subscribers, reaching profitability in the end of fiscal year 2023. In total, Disney is projecting to have between 300 and 350 million global subscriptions across their streaming services by the end of fiscal year 2024. If I was a betting man, I'd say Disney Plus will be on the low end of that estimate, with Hulu in the middle and ESPN Plus beating. It's still 3 full fiscal years out and difficult to tell though. Just as a rough estimate, let's see what kind of cash these subscriber numbers could generate. If we use the same average monthly revenue per user as the current day, then Disney Plus will generate $11.1 billion annually from 230 million subs. Hulu will generate $7.6 billion annually from 50 million subs. I'm also assuming in this scenario that Hulu with live TV will have no growth and stay at 4 million subs and will generate $4 billion annually. ESPN Plus will generate roughly $1.7 billion annually at 30 million subs. In total, the streaming services would generate roughly $24.4 billion in revenue if they hit these sub-estimates and have no increase in average monthly revenue per user. According to Disney's 2020 Investor Day presentation, where they announced these subscriber targets, they expect their global direct-to-consumer content expense to be between 14 and 16 billion annually by the end of fiscal year 2024. This excludes the cost of live TV packages for Hulu Live TV. So if we subtract the $4 billion of revenue generated by that segment, we're left with $20.4 billion in revenue. Given this estimate for content expenses, the streaming services could be generating between 4.4 and 6.4 billion in profits by the end of fiscal year 2024. Again, these are very rough estimates and it's highly unpredictable. Ultimately, it all comes down to the number of subscribers, average monthly revenue per user, and content expenses. On this point, I think Disney's strong portfolio of brands creates competitive advantages that will give them long-term pricing power. I think they will be able to incrementally increase the price of their streaming services, especially Disney Plus. These increases will drive up the average revenue per user. This clip of Warren Buffett helps explain why pricing power is so powerful.
Coca-Cola's been around since 1886. There's 1.8 billion 8-ounce servings of Coca-Cola products sold every day. Now, if you take 1 penny and get 1 penny extra, that's $18 million a day. And 18 million times 365 is 7 billion, 3 less 730 billion, or $6,570 million. So annually, $6,570 million from 1 penny. Do you think Coca-Cola is worth a penny more than, Joe's Cola? I think so.
I think this exact principle will apply to Disney Plus. People will pay up to get access to Disney's iconic library. At 230 million Disney Plus subs, a $1 increase in average monthly revenue per user generates an additional $2.76 billion in revenue annually. Over the long run, this will be so powerful. This is still out in the future though. Let's hear from Disney CEO Bob Chapek on how they're going to hit these subscriber targets.
A lot of focus on those Disney Plus subscriber numbers. The 2.1 million added was in line with what you said would be low single-digit millions, but much smaller than the 9 million that analysts had been anticipating. And this does raise some concerns about how you are going to get to those long-term goals. What do you anticipate being the drivers over the long term? How are you going to hit those numbers?
Right. We reaffirmed our guidance of 230 to 260 million households, and we believe that there are two primary drivers of that growth. First one is going to be the expansion into new markets. We're going to double the number of markets that Disney Plus is in international territories by fiscal year 2023. And the second component is obviously going to be new, fresh content across all of our wonderful Disney franchises. We have 340 new originals planned for our international markets over the next couple of years. So we are making a substantial investment in local content. We do believe that we offer a tremendous price value to consumers around the globe. And all of our research indicates that. And as such, we think we've got some headroom, if you will, in terms of pricing in the future.
Chapek mentions international expansion and pricing room in the future. Does that sound familiar? In this next clip, they are going to discuss performance of ESPN Plus and two things I think that could be game changers.
Now, one area of strength in those streaming numbers was ESPN Plus. Better subscriber growth than anticipated and also higher revenue per user. You reiterated your commitment to sports in general. What does that mean in terms of what kinds of sports rights you might go buy? The NFL Sunday Ticket, those rights are out there. Does this mean you're determined to get them?
Well, we are in discussions and negotiations with the NFL for those rights. We think they would make a particularly good addendum, if you will, to our ESPN Plus service, given the nature of what they are. But we're very bullish on sports. We mentioned during the earnings call the idea of gambling as a new revenue stream, a newfound revenue stream for us, which we think is spectacular. But as you know, with every one of the new rights deals that we cast over the last year and a half, every one of them has a very significant component for the DTC sports world. And so we're very bullish on ESPN Plus growth in the future.
Does that mean you have any more insight into when you might separate out ESPN Plus in terms of totally taking some of those rights that are on TV and shifting them over to streaming?
We're going to let the consumer be our guide there. The more and more the consumers try ESPN Plus and enjoy it and subscribe to it, gives us the wind in our sails, if you will, to believe that that's really where the consumer is going to go. And so we're gradually making those types of changes where we take a bit more every month, every quarter into ESPN Plus. And so far, it's been a very successful experiment.
So speaking more broadly about the competitive landscape, you have Amazon buying sports rights. You have Apple potentially in the running for those NFL Sunday Ticket rights.
Well, I don't think it's just about distribution. I think it's about the brand. If I were a league, I would want my sports rights to sit with ESPN because of what we can do. The Monday Night Football with Eli and Peyton, tremendous innovation. It's brought tremendous energy. It's in the cultural zeitgeist. And I think if we can do that as the Walt Disney Company, as ESPN for a sport, then that's basically where I think the rights should go.
Sports rights and sports gambling is huge potential for the Walt Disney Company. In my opinion, they should pursue NFL Sunday ticket rights as hard as they possibly can. If they get that, it would cement ESPN Plus as the sports streaming destination. Also, an increased focus on sports gambling could help connect ESPN Plus with a younger audience and tighten their existing relationship with DraftKings. Disney actually owns 18.43 million shares of DraftKings. This could get very interesting. There's so much long-term potential for Disney. I think their streaming bundle has the potential to be the streaming version of cable. Disney Plus, Hulu, and ESPN Plus are already strong, but imagine if they acquire just one or two more services to add to that value. Huge potential. Bob Chapek even commented on Disney's plans in the metaverse after Facebook's recent change to Meta made that the new corporate buzzword.
On the call, you mentioned the metaverse. Will we all eventually be paying Disney parks prices to go into the metaverse? What is your vision for Disney in the metaverse?
Well, my vision is to use Disney Plus as the platform for the metaverse. I think it really blends our physical beings with our digital beings and creates a three-dimensional canvas, if you will, for our creative storytellers to paint so that we can create experiences that otherwise have been defined as it's a park experience or it's a movie experience or it's a book experience. I think those all come together without boundaries, without borders, without constraints, and our creatives are just biting at the bit to get into the Disney metaverse.
And just so I'm clear, would this be something where you're wearing a headset, VR goggles?
Yes and no. It could be that, but I don't think that every one of those experiences is going to necessarily have to have a headset on. That is not our plan.
Despite metaverse being the new buzzword, this direction actually aligns perfectly with Disney's business. They are creatives who use technology to create stories and experiences. Virtual reality and augmented reality are just the next frontier of Disney's storytelling journey. Also, Disney has started experimenting with NFTs, which will be interesting to watch over the coming years. In conclusion, Disney stock has a lot of short-term negative forces working against it. The company has ugly financials as their parks business slowly recovers from the pandemic. Additionally, the narrative around their streaming growth story has been weakened by their most recent earnings report. This is a bad scenario. However, I will be using this as a buying opportunity. I'm extremely confident in the company long term and think it's set up to dominate over the next decade. That said, it will take time for the financials to recover, but by then, the stock price will likely be much higher. Thank you for watching Dividend Data. I'd greatly appreciate if you could leave a like and subscribe to the channel. You can support the channel over on Patreon, where you can gain access to a community Discord server. The link is in the description. Please leave a comment below, and thank you for watching.